Welcome to Money Depth Insights. I am the finance guide, John Nell. Today, we are talking about how real wealth is built without timing the market, and why index funds quietly sit at the center of that process for people who value clarity over complexity and consistency over prediction. Most beginners approach investing with the same hidden assumption. They believe success depends on knowing when to enter, when to exit, and when to act faster than others. That belief does not come from experience. It comes from noise. Charts, headlines, opinions, and stories of people who got lucky once create the illusion that timing is the skill that matters most. Over time, this illusion causes more stress than progress. Index fund investing exists as a response to that stress. Not as a shortcut, not as a trick, but as a recognition of how markets actually behave and how humans actually behave inside those markets. Before understanding index funds, it helps to understand the real problem they solve. The real problem is not lack of intelligence. It is emotional interference. Markets move constantly. Human confidence does not. Most people are calm when prices rise and anxious when prices fall. This emotional pattern leads to buying when things feel safe and selling when things feel uncomfortable. Over decades of market data, this behavior has been shown to reduce returns dramatically. Index funds remove the pressure to outthink the market. They are built on a simple idea. Instead of trying to choose individual winners, you participate in the overall growth of the market itself. You stop asking which company will win next and start asking whether the economy, over time, will continue to grow. History suggests that it does, despite recessions, crashes, and uncertainty. An index fund is simply a collection of many companies bundled together to represent a market or a segment of the market. When you invest in one, you are not betting on a single outcome. You are aligning yourself with long-term economic progress. That alignment changes how investing feels. It becomes less reactive and more deliberate. For beginners, this matters deeply. Most early mistakes are not analytical mistakes. They are behavioral mistakes. People check prices too often. They react to news that does not matter long term. They change direction too quickly. Index funds reduce the number of decisions required, and fewer decisions often lead to better outcomes. Another reason index funds work well for beginners is that they respect time rather than fight it. Timing the market requires being right repeatedly. You must decide when to get in, when to get out, and when to return. Missing just a few strong days can significantly reduce long-term returns. Index fund investing avoids this problem entirely by staying invested. Staying invested sounds simple, but it is emotionally difficult. Markets do not move smoothly. They move in waves. Index funds accept this reality instead of resisting it. Volatility becomes a normal part of the process rather than a signal to act. Over time, this normalization builds confidence without forcing certainty. One of the most common beginner mistakes is waiting for the perfect moment to invest. People wait for clarity, for stability, for reassurance that the market is safe. The problem is that markets price in optimism long before people feel comfortable. By the time confidence returns, prices have often already moved higher. Index funds reduce the need for perfect timing by spreading entry over time. This is where consistent investing becomes powerful. Investing regularly, regardless of market conditions, allows you to participate in both downturns and recoveries. Downturns feel negative emotionally, but they often improve long-term outcomes by allowing investments at lower prices. Index funds make this process automatic and emotionally manageable. Another overlooked advantage of index funds is diversification. Beginners often underestimate how much risk exists in single companies. Even strong businesses can fail, stagnate, or lose relevance. Index funds spread that risk across hundreds or thousands of companies. This does not eliminate risk, but it transforms it into something survivable. Survivability is a core principle of long-term wealth building. The goal is not to avoid every loss. The goal is to avoid catastrophic mistakes that remove you from the game entirely. Index funds are designed to survive uncertainty, not predict it. Cost is another critical factor. Index funds are typically low cost because they are not actively managed. Over long periods, fees compound just like returns. High fees quietly reduce growth year after year. Lower costs leave more capital invested and compounding. This difference may feel small early on, but over decades it becomes substantial. Many beginners believe complexity equals sophistication. In reality, complexity often hides unnecessary risk. Index funds are simple, but simplicity does not mean weakness. It means clarity. When you understand what you own and why you own it, you are less likely to abandon your plan during stressful periods. Another important shift that index funds encourage is moving from performance obsession to process discipline. Instead of asking whether the investment beat the market this year, you begin asking whether you followed your strategy consistently. This shift reduces emotional decision-making and increases long-term stability. Index fund investing also aligns well with real life. People have jobs, families, responsibilities, and limited attention. Constantly monitoring markets is unrealistic and unnecessary. Index funds allow wealth building to happen quietly in the background while life continues. It is also important to address a common misunderstanding. Index funds are not passive in outcome. They are passive in management. The underlying economy remains dynamic. Companies compete, innovate, and fail. Index funds adapt automatically as markets evolve. You are not freezing your capital. You are allowing it to move with economic reality rather than personal prediction. Some people worry that index funds feel boring. That is often true. But boredom in investing is not a flaw. It is protection. Excitement often leads to overconfidence. Overconfidence leads to mistakes. Calm investing supports longevity. Another real-world observation is that people who succeed with index funds rarely talk about it loudly. Their progress is gradual. There are no dramatic stories, just steady accumulation. This quiet success is often overlooked because it does not generate headlines, but it builds real outcomes. Index funds also help beginners separate identity from outcomes. When you are not trying to beat others, investing becomes less personal. Losses feel less like failure. Gains feel less like validation. This emotional neutrality supports better behavior. Over time, index fund investors begin to see volatility differently. Market drops become part of the plan rather than reasons to panic. Recovery becomes expected rather than surprising. This psychological shift is one of the most valuable outcomes of long-term investing. Another benefit is flexibility. Index funds can support different goals, timelines, and risk tolerances. They are not a single solution, but a foundation. As understanding grows, strategies can evolve without abandoning core principles. It is also worth noting that index funds do not require constant optimism. You do not need to believe the future will be perfect. You only need to believe that human productivity, innovation, and adaptation will continue over time. History supports this belief, even through periods of crisis. For absolute beginners, the most important lesson is this: wealth is not built by avoiding uncertainty. It is built by designing systems that function within uncertainty. Index funds are one such system. They acknowledge what cannot be controlled and focus on what can. You cannot control market timing. You can control consistency. You cannot control short-term prices. You can control long-term participation. Index funds align behavior with these realities. As experience grows, many investors realize that their biggest enemy was never the market. It was impatience. Index funds reward patience not because patience is noble, but because patience allows compounding to work without interruption. Compounding does not need excitement. It needs time. Every unnecessary decision interrupts time. Index funds minimize interruption. This does not mean index funds guarantee success. No investment does. But they significantly reduce the likelihood of self-inflicted failure, which is where most losses come from. The real value of index funds is not just financial. It is psychological. They create space. Space to think clearly. Space to live fully. Space to let money work without constant attention. When investing stops feeling like a test you must pass and starts feeling like a process you respect, stress decreases. Confidence grows. Discipline becomes easier. That is how wealth is built without timing the market. Not through prediction, not through urgency, but through alignment between behavior and reality. If this explanation helped you see investing more clearly, share your thoughts in the comments. And if you believe this understanding can help someone in your colleague or friend circle, make sure to share it with them. Education grows when knowledge is shared. This video is created for educational purposes only. For more calm, practical, and long-term financial understanding, subscribe to Money Depth Insights. I am the Finance Guide, John Nell, and I will see you in the next session.